If you were born before 1960, the day you turned 67, you became legally exempt from a whole stack of bills, taxes, and charges you are almost certainly still paying. And nobody whose job it is to collect that money is ever going to call and tell you to stop. I want to be very clear about what I just said because it is the single most expensive misunderstanding I see year after year. Turning 67 did not just make you eligible for the age pension. It quietly moved you into an entire category of people that the tax office, Centrelink, your state government, and several other agencies are required by law to treat differently. There are bills younger Australians have to pay that you no longer do. There are taxes that get smaller or disappear completely the moment you cross that line. But here is the catch that costs people thousands of dollars every single year. Being legally exempt and actually not paying are two completely different things. The system does not refund you automatically. Nobody at the tax office or Centrelink posts you a check. The agency that has been collecting that money for decades does not send you a letter on your birthday saying, "Congratulations, you can stop now." You have to know the exemption exists, and you have to lodge the form. That one gap between qualifying and claiming is the reason most people who are fully entitled to these never see a dollar of them. And before you decide this video is not for you, let me clear up the biggest myth of all. Because this is exactly how people talk themselves out of money that is sitting right there with their name on it. People assume a list like this is only for low-income retirees who are really struggling. So if you own a comfortable, paid-off home, you tune out and you assume none of it applies to you. Then other people assume the opposite. They think this is only for the wealthy, the self-funded retirees with big super balances and an accountant on speed dial. So if you live mostly on the age pension, you tune out too. Both of those people are wrong, and both of them are leaving money on the table. Some of the things on this list help the modest income retiree the most. Others are worth the most to the self-funded retiree who assumes they earn too much to qualify for anything. On every single one, I'll tell you exactly who it helps the most, so nobody watching can honestly say, well, that part is not for me. And if you're renting right now, do not click away either, because your landlord pays the council rates on that property, and every increase gets passed straight into your rent. So let me tell you who I am and why I'm the one telling you this. My name is Marcus Pierce. Now, I'm not a financial advisor, and nothing in this video is personal advice. I'll come back to that at the end. But for more than 15 years, I've represented ordinary taxpayers in front of the tax office, Centrelink, and the state agencies, on behalf of regular Australian families. And I'll tell you the most painful pattern I've seen in all those years. It is not the people who try to cheat or game the system. Those people are rare. The painful one is the honest Australian in their 60s, 70s, and 80s who has done everything right their whole life and who is paying bills they stopped owing years ago, simply because not one single person ever sat them down and told them which form to lodge. That is the most expensive kind of mistake there is, because it is completely invisible. There is no overdue notice, there is no penalty, there is no alarm that goes off. There is just money quietly leaving your account every fortnight, every year, that never had to leave at all. So let's fix that right now. I'm going to walk you through 5 of these, one at a time, in plain English, with the exact thing to ask for on each one. Then I'll give you a few bonus moves at the end for the retiree with some real assets. And stay with me for those because they can be worth more than everything else on this list combined. Let's start with the one hiding in plain sight on your own tax return. A huge number of retirees pay income tax they simply do not owe because of an offset most people have never had explained to them properly. It's called SAPTO, the Seniors and Pensioners Tax Offset. Here's what it does. The standard tax-free threshold in Australia is $18,200. That's what every working age person gets. But once you've reached pension age and you're eligible, SAPTO stacks together with the low income tax offset and lifts the income you can earn before paying a single dollar of tax to around $35,800 for a single person, nearly double. For a couple, each partner can earn roughly $31,900. And this is an offset, not a deduction. It doesn't just shrink your taxable income, it comes straight off the tax itself, up to about $2,200 for a single. Here's what genuinely bothers me about this one. The person it helps the most is the exact person least likely to catch it. The retiree on a modest income who lodges their own return or hands it to a busy preparer working through a stack of them and never notices whether the offset was actually applied. And you do not have to be on the age pension to get it. Self-funded retirees who'd be eligible on age and residency can claim it too. So the action here takes 2 minutes. When your return is done, before you lodge it, confirm SAPTO was actually applied and make sure your date of birth and pension status are recorded correctly, because that's what triggers it. And if you've been overpaying in past years, you can often ask the tax office to amend them. This isn't a fight with anyone. It's a box that simply has to be ticked correctly. Number 2 ties straight to the one we just covered, and it's the one I see cost people the most, year after year. If you own Australian shares, directly or through a managed fund or your super, the dividends often come with franking credits attached. That's tax the company has already paid to the tax office on your behalf. And here's the part almost nobody acts on. If your own tax rate is low or zero, which, thanks to SAPTO, describes a huge number of retirees, those franking credits are refundable. The tax office sends you the cash. But here's the trap, and it's a quiet one. The very same retirees who owe no tax often think, well, I don't earn enough to bother lodging a return, so they don't lodge at all, and they leave that refund sitting with the tax office every single year. For some self-funded retirees, that's not pocket change. It's thousands of dollars a year, handed back to the government for no reason at all. In my reading of it, this is one of the most common and most fixable money mistakes retirees make in this country. The fix is one of the easiest on the entire list. Lodge a return, or the specific refund of franking credits claim, even if you owe no tax. Confirm with the tax office how it applies to your holdings, because everyone's situation is different. But for a lot of you, that one form is worth more than several of the others combined. Number 3 is the one comfortable retirees talk themselves out of fastest, and it's a mistake that costs them all year long. It's the Commonwealth Seniors Health Card. Here's where people get it wrong. They hear the word card, assume it's a welfare thing, and decide they've got too much in super or savings to qualify. But the Commonwealth Seniors Health Card has no assets test at all. Your paid-off home and your super balance do not disqualify you. There's only an income test, and the limit is far higher than people assume. Just over $100,000 a year for a single, and around $160,000 combined for a couple. That is not a poverty program. That's a working and middle-income retiree program. And look at what one application unlocks, all stacked together. Your prescription medicines drop to the concession rate. That's a maximum of $7.70 a script, locked in until 2030, instead of up to $25 a script as a general patient. On top of that, the card opens the door to state-based concessions on your energy, your water, your car registration, and public transport, depending where you live. Over a year, for someone filling several prescriptions a month and running a household, that is real money. Who does it help the most? The self-funded retiree who is not on the age pension and assumes none of this applies to them. That's exactly who it was designed for. The action is simple. Check the current income test on the Services Australia website. Use that official figure, not whatever some article tells you, and lodge the application. One form, a stack of savings. Number 4 is for the retiree who already gets even a part age pension. Because the day your pension is approved, you're issued a pensioner concession card, and most people never use half of what it quietly unlocks. Here's the thing almost nobody is told. These concessions don't switch on by themselves. The card makes you eligible, but in most cases you still have to apply to your council or your state. The council rates concession for pensioners, worth up to around $250 a year depending on your council and state. Usually has to be applied for, once, and most pensioners assume it's automatic when it isn't. Same with the energy and water concessions your state offers, the registration discount on your car, and cheaper public transport. Every one of those is a separate tick box, and the agency that collects the money is in no hurry to remind you. Who does it help the most? Anyone living mostly on a full or part age pension. The action is 2 phone calls. Ring your council and ask, by name, whether the pensioner rates concession is on your rates account. And if it isn't, ask which form adds it. Then check your state government's concessions page, or ask Services Australia about the energy, water and transport concessions your card entitles you to. Number 5 is smaller in dollars, and I'm not going to pretend otherwise, but it's still money the system already decided people in your situation shouldn't have to carry in full, so I won't skip past it. There's the telephone allowance bundled into the pension supplement. There's the seniors and pensioner transport concession in your state. There's the registration discount on your vehicle. Individually, none of these will change your life. But here's how I want you to think about it. Each one is a recurring cost the system has already agreed you shouldn't carry alone, and each one is sitting there unclaimed for the same reason as everything else on this list. You only get it if you ask. When you stack the small ones on top of the big ones from earlier, that's when the monthly number really starts to move. Now, if you've got some real assets behind you, here are the 3 moves I saved for last. Because for the right person, these are worth more than everything else on the list combined. The first is the downsizer contribution. If you're 55 or older and you sell the family home, you can put up to $300,000 each, $600,000 for a couple, of the sale proceeds into super, on top of the normal contribution caps. For the right person, that's a powerful way to move money into a low-tax environment late in life. Check the eligibility rules carefully first. The second is the surviving spouse trap. When one partner passes away, the concessions, the card, and the pension rate do not simply roll over to the survivor. They often have to be reapplied for, and there's a bereavement period and payment that many families never claim. If the survivor doesn't act, the household's costs can jump in the worst possible year, the exact year it just lost half its income. The paperwork is short, the deadlines are real. Don't let it slip. And the third is the one people laugh at until they add it up, the state seniors card. It's free, it's usually available well before pension age regardless of your income, and it stacks discounts on transport and on countless businesses for the rest of your life. Small each time, yours, sitting there. Let me bring all of this back to one person. I once worked through this with a woman I'll call Margaret, 72, a widow up in regional Queensland living in a paid-off home on a small account-based pension topped up by a part-age pension. When we actually sat down and looked, here's what we found. She was paying income tax she didn't owe because no one had applied SAPTO to her return. She had never once claimed the franking credit refunds sitting in her share dividends, and she didn't hold the concession card she clearly qualified for. So we lodged 3 things: a corrected return with SAPTO applied, a franking credit refund claim, and her concession card application. Nothing about Margaret's life changed. She didn't move, she didn't sell a thing. The only thing that changed was how much of her own money stayed in her account at the end of each month. And here's the part I want you to really hear. She wasn't gaming anything. She was simply finally claiming what she'd already earned over a lifetime of doing everything right. So here's exactly what I want you to do this week, and none of it costs you $1. First, the next time your tax return is prepared, confirm SAPTO was applied. Ask whether you're owed a franking credit refund, and ask whether prior years can be amended. Second, check the Commonwealth Seniors Health Card and Concession Card income tests on the Services Australia website and apply if you're eligible. Third, ring your council about the pensioner rates concession and check your state's energy, water and transport concessions. And if the cost of paying someone is part of why you've been putting this off, you don't have to pay anyone. The tax office runs a free tax help program staffed by trained volunteers for people on lower incomes, including seniors, and they know exactly which offsets to look for. And Services Australia has a free financial information service. It's government run and it doesn't sell you anything. For most of you, the cost of finally catching every one of these is nothing at all. That's it.